What I'm looking for in the next year or two, with the great stagflation becoming a more entrenched theme, with the massive amounts of debt that needs to be issued and refinanced, with the inevitability that the Fed and everybody else just keeps printing and printing and printing more. They put on a brave face trying to, normalize or tighten for as long as they can get away with it, but that's about done. The next major leg, I don't like putting price targets on things. I like to look at conditions, but I don't think when gold does finally break out, we only go up 100 or $200.
Analysts, such as ChrisTemple from the National Investor, are optimistic about the outlook for gold. Temple suggests that gold has limited downside, citing various factors that could propel the yellow metal higher. He anticipates a substantial upward movement for gold when it breaks out, projecting more than a modest increase of $100 or $200. As of midday U.S. trading on Tuesday, February, gold prices are slightly higher, at $2,060, despite renewed demand for the U.S. dollar. Temple points out that macroeconomic conditions are deteriorating, supporting the idea that gold prices could hit new highs in 2024. Bloomberg Intelligence senior commodity strategist McGlone even suggests the potential for gold to reach $3,000. Temple underscores the market's reaction to recent dovish commentary by Federal Reserve Chair Powell, leading to a rally in various assets, including gold. This resulted in a decline in the U.S. dollar and a surge in Treasury bond prices. The CME Fed Watch tool indicates that the markets have priced in no hike for the January meeting, with rate cuts forecasted for March and May 2024. Drawing parallels with the post-2008 financial crisis period, Temple suggests that despite Fed easing, if fundamental statistics deteriorate and recession concerns arise, gold could become a beneficiary of monetary easing amid economic challenges. In 2009 and 2010, gold outperformed many other assets, shining exceptionally bright during times of crisis and elevated risk aversion. Investors often turn to gold as the ultimate haven to protect their capital. However, as the economy recovered, gold lost its appeal as insurance against the monetary system breakdown based on fiat currencies, marking the end of the gold bull market in 2012. Just before you watch Chris Temple's interview, make sure to subscribe to our channel and give this video a big thumbs up.
First factor is that we need to have a Fed that is in an expansionary mode, monetary policy-wise. It is not yet at that place. It's taken a step, arguably, in that direction. If Powell and the rest of them, with their winks and nods, really have raised the short-term interest rates for the last time, keep in mind that at least on the surface, they're still reducing their balance sheet by a fair bit. But it's been pointed out that even, in and out the back door through their bank lending facility and their other open market operations, that they're still having to paper over a lot of trouble in the banking system. So number one is that once it's much clearer to the markets that the Fed has ended any further monetary policy tightening, let alone flips in the other direction, that's the first ingredient. The second ingredient is that you're going to need to see a situation where, despite the coming, and it will come probably in 2024, the coming Fed capitulation, where whatever the reasoning, it just cannot tighten and may have to start to ease it again somewhat. That can't be seen as helping the broad economy, because look at what happened just recently. You had a situation where everybody scrambled, tripped over one another when Powell gave his surprisingly dovish commentary. Whether you believe it or not doesn't matter. People did. Okay, and they're buying. What are they buying? Did they buy just gold? No, gold responded positively to the idea that the Fed's done hiking, as it should have. But what responded a whole lot more was the U.S. dollar going down, Treasury bonds on a blistering rally higher. 20% gains in Treasury bond prices in a couple of weeks. Okay, you had stocks flying higher. We've got a new high, all-time high for the Dow, for the NASDAQ 100, maybe by the time this is posted, even for the Standard & Poor's 500. So when the Fed reverses course and is easing, but the economic and fundamental statistics are deteriorating, and people are realizing, maybe we are going to go into a recession no matter what the Fed does, And all of a sudden, what sound like the easy trades of buying more of the Magnificent Seven, buying more high-tech growth and what, that's all of a sudden not looking good. And, I think that the earnings are going to be a lot less going forward than people realize. You look at the news out recently from everybody from Walmart to Target to FedEx, consumers are already rolling over and spending less. If you adjust it for inflation, consumer spending dropped 4% from last Christmas. That's when gold is also going to get more attention, because monetary easing that helps all sectors, gold does okay, but it's more of a wallflower. But when things are deteriorating for the economy and earnings, and the Fed is still printing money, by process of elimination, it's going to benefit gold even more. And that's what we had, in the wake of the financial crisis in 2008. So I think I actually morphed reasons 2 and 3 into one. So I was talking about the markets and the economy both. But as you see the economy deteriorate and the growth stocks start to do worse, yet you've got the monetary tightening, or the monetary easing rather, that's when gold really takes off. And we're getting glimmers of that, but it's not, I'm saying we're at a caution light about to turn green rather than back to red.
In a recent survey conducted by Bank of America Global Research with the top 13 silver producers, the consensus is that revisiting the 2016 highs in mine supply is unlikely for several years. Challenges related to funding, permitting, and the complexities of bringing a new mine to market are increasing, making such milestones challenging. Echoing this sentiment, ChrisTemple emphasizes that 2024 will mark the 4th successive year of a supply deficit for silver. He attributes this deficit to a surge in demand, mainly driven by the increased use of silver in solar panels and various technological applications. One noteworthy aspect highlighted by Temple is the drop in overall demand for silver in 2023, with the jewelry, silverware, and physical investment sectors experiencing a correction after the outsized demand observed in 2022. Temple further suggests that silver tends to follow the lead of gold during new secular moves, often surpassing it in each cycle. This pattern hints at a potential bullish trend for silver, aligning with the anticipated upward movement in gold prices. Despite the positive outlook for silver, current market conditions show slightly lower prices. While there is some modest safe haven demand, the gains in the US dollar index and lower crude oil prices have subdued buyer interest in precious metals, including silver. Let's get back to the interview.
Well, there's a reason why gold has been tagging and then retagging and then retagging and maybe making a new nominal all-time high for a while now. You're going back to 2020, really. While silver is not quite half of its all-time high. First of all, it shows you that the action in gold has been even more relegated to central bank buying and some of the more extreme risk-averse money that just wants to buy physical gold. Those people don't buy silver for those reasons. They buy gold, especially the central banks. The industrial case for silver, I think, is completely misunderstood. We're going to be going into the 4th successive year in 2024 of a silver supply deficit. Okay. So, but it's like my long-term prognosis for silver is great. The increased demand for solar panels, a lot of technological reasons and so forth. And again, when you've had such underdevelopment of other base metals, and keep in mind that it's something like 70% of all of the new silver production comes as a byproduct. If it's going to take a long time for new lead and zinc and copper, gold, and other mines to come online, then it's going to take that much longer for more silver to come to market, all else being equal, and close that supply shortfall. So I think that silver is, I don't want to get into it, I don't want to say unnaturally low and feed some of the conspiracy theorists who every time they make a bad call, it's also the short seller's fault, okay, or JP Morgan's fault or whatever. I hear all those arguments all the time. I think that ultimately the fundamentals will win back out. And I do think that the near-term opportunity with silver is less about the energy transition and so forth than it is when gold really starts to take off, because inevitably in every cycle where you see gold make a new secular move, it takes the lead early and then silver catches up and overtakes it. And there's no reason to believe that that won't be the same this time around, aside from any of the industrial and green energy applications for silver.
After watching ChrisTemple's interview, what are your expectations regarding his insights on the outlook for gold? And how do you perceive the current market conditions influencing these projections? With 2024 marking the fourth successive year of a supply deficit for silver, what strategies do silver producers have in place to navigate these deficits? And how might this impact the overall dynamics of the silver market? Share your thoughts in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.